Have you ever been given advice about the housing market and you think to yourself, man, there must be a better way? Most people think shopping rates or taking a builder's deal is the best solution to today's interest rates. But what they don't realize is there's an even better way to get a much lower rate. Well, hello, this is Wendy Pennell, and to all of my homeowners out there, man, we are just in a dilemma, aren't we? Today, a staggering 85% of homeowners are locked into mortgage rates below 5%. Now, I hear you asking, Wendy, how's that a bad thing? Well, I hear you, but what about when these homeowners want to move? I mean, maybe you've outgrown your home, or you want to downsize, or you have to move. Today's 7% interest rates really leave you in a tough spot. And the thing is, you probably have a decent amount of equity. I mean, maybe like $100,000 or more, but that equity isn't doing you any favors. So you start asking around, and the best advice you can get is to shop interest rates. Call as many different lenders as you can. And some people might tell you, hey, go with new construction. They offer specials. And they do, don't get me wrong, but I'm telling you, there's still a better way. Jason Stoffer from CNBC hit the nail on the head when he said homeowners are hesitant to make a move because they don't want to give up their low mortgage rates. And who can blame them, right? If you've got a $300,000 mortgage at a 3% rate, you're paying roughly $1,265 a month. Bump that rate up to 7% and your monthly payment skyrockets to nearly $2,000. It's like your equity just evaporates. To keep your monthly payment at $1,265 with a 7% interest rate, you would need to slash your $300,000 mortgage down to $190,000. That is a huge cut, and most people just can't swing it. Here's a great example from financial advisor Damian Winther. Let's assume you've done your financial homework and have determined the ideal principal and interest payment for you and your family would be $2,500 a month. Still, a 30-year mortgage rate is 6% in today's market environment. We know a couple of years ago that you would have been able to afford a $600,000 home and the monthly payment would fit your budget. Today, with higher interest rates, the homes you'd need to look at to have a monthly principal and interest payment of $2,500 would be $416,979. So with interest rate changes, you've now gone from being able to afford a $600,000 home to a $416,000 home. But hang on a second, okay, it gets even crazier. Let's say you want to trade up. All right, you're eyeing a $400,000 home, but you want to keep your monthly payment the same. You would need a down payment of $210,000. And that's not even factoring in the closing costs, right? Both when you sell your current home and then buy the new one. Tally up those extra expenses, and you would need around $250,000 in cash just to keep your monthly payment the same on a $400,000 home. You see, it's so easy, right, to think you're sitting on a gold mine when you have all that equity, but that treasure evaporates in a flash when you factor in today's interest rates. Well, if you've been losing sleep over those skyrocketing interest rates, I've got some good news for you. Have you ever heard of Assumable Loans? All right, they may just be the financial lifesaver you're looking for. I mean, how great would it be if you could assume someone else's 3% interest rates, right? Well, don't take my word for it. Renee Bermudez of LendingTree.com sums it up really well. She says with mortgage rates sitting at a relatively high 7.44%, for 30-year loans, it's a rough environment for home buyers. She continues, loan assumption, however, allows a buyer to take over the current owner's mortgage while the loan's terms, including the repayment period and interest rate, remain the same. She concludes, ultimately, it can help people get into a home at a lower interest rate, even as the housing market around them becomes more expensive. Bermudez offers some more good news. She says, additionally, sellers who can offer loan assumption may have a leg up on others because they can provide the opportunity to lock in low interest rates. Then she points out, in some cases, they can even sell their home at a higher price because the lower interest rate offsets the higher principal amount. Assumable loans won't work in every situation, and they won't work with new construction. But if you're willing to consider a pre-owned home, an assumable loan just might be your winning ticket. Now, here's what you need to know. Not all loans are created equal, and assumable loans are no exception, all right? First off, you have FHA loans. Now, these are generally assumable as long as the lender approves. If the loan originated on or after December 15, 1989, and you're creditworthy, you're good to go. You also have VA loans. All VA loans are assumable. However, loans originated after March 1, 1988 require lender approval and a processing fee. USDA loans, these come in two flavors, right? Assumable with new rates and terms, or assumable with the same rates and terms. The latter is usually going to be like for family exchanges. And then we have conventional loans, okay? These are rarely assumable due to the due on sale clauses. But if you've got an adjustable rate mortgage, you might be in luck. Now that we've covered the types, let's get into the nitty-gritty of what an assumable loan really is. Jason Stoffer does a great job of explaining what this looks like. He says the buyer takes over the seller's existing loan and keeps its interest rate and repayment terms. He points out approximately 85% of properties have loans with a mortgage interest rate below 5%, according to Redfin. This represents a potential for significant savings for buyers and could make it easier for owners to sell their homes. Now, you're probably wondering, all right, Wendy, this sounds amazing, but what's the catch? Well, that's a good question. And first and foremost, your absolute biggest obstacle will be people just don't understand that these mortgages exist. And if they have heard of them, all right, all they've heard is like misinformation. Now, once you hear the word assumable mortgage, either people are like, what are you talking about? Or they're going to have something to say about them and most of that's going to be wrong, okay? So this is your first catch, all right? It's just plain educating people. Secondly, just like with a standard mortgage, you'll need to pass the lender's qualifications. We're talking credit checks, reviewing your debt to income ratio, the whole 9 yards. But that's probably not a catch for you, all right? If you've been considering buying anyway, you already planned on having a lender work through the approval process. You also have to consider that this golden ticket is only available for government-backed loans, okay? So we're talking, FHA, right? VA, USDA. According to Jason Stoffer, government-backed loans have only made up about 18 to 26% of residential loan applications in the past 3 years. That means the number of available homes with government-backed loans on the market may make them a little bit challenging to find. Another obstacle is the down payment that you're going to need with an assumable loan. Okay, an assumable doesn't cover the difference between what the seller owes, meaning the amount of his mortgage that you'll be assuming, and the profit he wants to make from selling. Okay, in other words, the sales price. You as the buyer, you have to make up that difference. All right, and this is why this is such a fantastic opportunity for current homeowners. When you sell, you have that equity. It just hasn't done you any good when you have to trade up to a 7% interest rate. Here's an example that will help all of this make sense, all right? Let's say my client, Bob, decided he wanted to sell his house. He had a VA loan when he purchased his home 3 years ago with a great interest rate of just 3%. He still owes $400,000 on his loan, and the home is currently worth $500,000. So Bob has $100,000 of equity to collect when he sells, all right, minus cost of sales, right? That means when a buyer comes, the buyer will assume his $400,000 loan and have to bring an additional $100,000 in cash to the closing table in order to complete this sale. Bob wins because he sold his house and claimed his equity. The buyer wins with an amazing interest rate along with a new home, and everyone has a great day. Now, will this strategy work for every home buyer? Well, no, but it will work for the right buyer. If you're a first-time home buyer who's scraping the barrel to muster up a down payment, this assumable loan strategy is not going to be your best friend. Right? The high amount you would need to bring to the closing table is likely unreachable. On the flip side, like I mentioned earlier, if you're selling your current home and expecting a nice fat check at closing, this is where assumable loans shine. All right, that equity you're walking away with, right? It really hasn't been doing much for you. But if you can jump into an assumable loan with a 3% interest rate, all right, now we're talking, right? Your opportunity to claim Bob's interest rate just became way more real. If you're starting to have light bulbs go off by now, okay? And your excitement level is getting bigger, let's take a dive into the nitty-gritty, okay? How does this whole assumable mortgage thing actually work? Well, first and foremost, you'll need to find homes with assumable mortgages. Now, we're not talking about brand spanking new homes here, right? These are going to have to be pre-owned homes, and they'll need to have been purchased with a government-backed loan, like an FHA, VA, or USDA mortgage. Now, if you're thinking, how on earth do I find these homes? Well, this is where a knowledgeable realtor comes into play, right? Okay, we can look up the MLS and deed history data to identify these properties for you. It's not rocket science, right? It's just a matter of knowing where to look. And speaking of looking, Remember that mortgages are recorded and are public record. So the information is out there, all right? You just need to know how to find it. Now, if you've watched any of my videos before, you know strategic home buying is extremely important to me. All right, so let's talk about some of the strategies in finding these assumable mortgages. All right, first off, you want to look for recent homeowners. Your best case scenario is a home seller who's only been in the home for a few years. Now, why is that? Well, because they're likely to have less equity. And that's golden for you because it means your down payment will be smaller. Remember, you're covering the gap between the loan you're assuming and what the seller wants as profit. Secondly, and another reason you want to find a home that's been sold within the past few years is you want to take advantage of the golden era of 3% rates. If the homeowner bought their place when interest rates were dancing around that, dreamy 3%, all right, that's even better. But don't fully give up on homeowners who bought more than a few years ago, okay? Chances are they've refinanced and they may very well still have a 3% rate. For that reason, you don't want to just look at how a homeowner purchased his home. Check if they've refinanced and more importantly, what type of loan they switched to. We're aiming for government-backed loans here like FHA or VA or USDA. So for example, if they refinanced out of their VA loan, you're out of luck, all right? So your goal is triple fold. A seller with a government-backed loan, minimal equity, and a low interest rate. It might sound like finding a needle in a haystack, but trust me, with a sharp realtor by your side, you can find these gems online. Which, by the way, if we sound like your kind of people, you're definitely gonna want to check out our Let's Find Home questionnaire that you can find in the description section. All right, yet another strategy is finding a motivated seller. This could very well be the key to landing a home with an assumable mortgage. Now, why is that? Well, remember how I said your biggest obstacle to assumable loans is people either haven't heard of them or they've heard horror stories. Well, a motivated seller is going to be a lot more willing to listen. All right, so how in the heck do you find a motivated seller? Well, Carrie Kirby from Wisebread sheds light on some signs you want to look out for. Your first way, and probably your easiest to find, is advertised motivation. Some listings are going to come straight to the point and mention motivated seller. Others might be subtler, stating things like bring all offers. Another way is if your seller is moving far, okay? If the seller has gotten a job transfer across the country or even overseas, they probably won't have time for protracted negotiations. Or how about a life status change? If the seller is going through significant life changes like marriage or divorce, they're likely motivated to sell quickly. Look for clues such as half-empty closets or wedding arrangements in the house. Or how about a completely empty house? All right, an empty house usually means the owner has already moved and is likely paying for 2 properties. They'd be eager to close the deal. And finally, be on the lookout for an overcrowded house. All right, a house bursting at the seams with furniture and belongings indicates the seller needs to upgrade to a bigger space as soon as possible. Okay, so why should you care about what's causing a seller to be motivated? Well, it can guide you in how to approach them with your offer. The flexibility of a motivated seller can be a gold mine when you're looking into assumable mortgages. They're more likely to be open to unconventional arrangements like letting you take over their low interest loan. Once you've scouted out the ideal property and you're convinced the seller's motivated, the next big question is, will the seller work with you on an assumable mortgage? Now, this is again where you want a good communicator on your side. Okay, you need someone who can articulate the benefits and process of loan assumption clearly to the listing agent, who will then need to communicate it to the seller. A good old-fashioned video explanation can be a godsend. All right, this ensures that the concept isn't lost in translation, right? Especially if the listing agent isn't well versed in assumable mortgages. Speaking of agents that may not know much about assumable mortgages, let's talk about that biggest obstacle I mentioned earlier. People either haven't heard about assumable mortgages or they've heard horror stories. It might happen, this way. A buyer asks a seller if he can assume the seller's mortgage. The seller hasn't heard of assumable mortgages before, so he posts on Facebook asking if anyone has heard of them. The next thing you know, 50 different people have posted what they've heard from other people about assumable mortgages, and most of it is wrong. So let's talk about the biggest misconception on assumable loans that you need to know. Okay, you ready? Here it is. Release from liability. Okay? In today's modern day assumptions, the seller does not continue to be on the mortgage or hold the title after the sale. Now let me say that again for the people in the back, okay? With today's assumptions, the seller does not continue to be on the mortgage or hold title after the sale. A release of liability contract is drafted and signed at closing to ensure the new home buyer assumes not only the mortgage, but also the full responsibility for repaying the loan. Also, the lender must agree to fully release the current mortgage holder. Okay, so on this issue, people are going to be very insistent, and here's why. Back in the day, assumable mortgages were known as non-qualifying. Since the new buyer didn't even have to qualify, who knew if they even had a job, the seller had to stay on the mortgage and continue to be liable. Let's check in with some experts on this. All right, when it comes to the issue of liability, Investopedia states, to avoid liability, the seller must release their liability in writing at the time of assumption, and the lender must approve the release request, releasing the seller of all liabilities from the loan. Lending Tree describes it this way: the safest type of assumption is novation, which is when the lender agrees to let the buyer take responsibility for the existing mortgage. Because the lender will put the buyer through the underwriting process before giving its approval, it is willing to release the seller from all future responsibility for the mortgage payments. Today's assumable mortgages are called qualifying assumptions. The lender will fully qualify the borrower, the same as if you were obtaining a loan from a traditional lender. And at that point, you ensure the seller is released from any and all liability. All right, so once you've cleared up any misconceptions and you've gotten the seller on board, what else is there to do in this process? Well, quite a bit actually, okay? Finding a home and a willing seller is just one part of the process. Once you're convinced that the property and the seller are a fit for an assumable mortgage, it's time to take action. We'll want to really take a look at the property in detail, and if everything checks out, we will draft and submit the offer to get you under contract. Now let's pause and think about this for a minute. All right, when a lender decides to loan money for a home purchase, they have to qualify two things, right? You as the borrower, and the home as collateral. Well, in the case of an assumable mortgage, the home has already been qualified as collateral. Hence, the lender only needs to qualify you as the borrower. All right, so what does this mean for you? Well, a faster close. Since the lender is already familiar with the property, you avoid the time-consuming steps of property appraisal and approval. Also, lower closing costs. Okay, conventional wisdom states that closing costs for the buyer can range anywhere from roughly 2 to 6% of the purchase price. But when you assume a government-backed loan, situation's different. Renee Bermudez with Lending Tree points out closing costs on assumed government-backed loans are cheaper than the 2 to 6% you'd normally pay to close a loan. She adds that each type of government loan has a cap on fees at closing, which keeps your expenses lower than usual. So not only do you get to assume a loan with a potentially lower interest rate, but you also benefit from lower closing costs and a faster closing time. All right, it's like hitting a home buying trifecta. So what's the best scenario for a home buyer walking into an assumable loan? All right, well, let's talk about that. We've been operating under a certain assumption throughout this discussion, right? That you're selling your existing home and walking away with a substantial down payment. If this describes your situation, you are in a particularly strong position to take advantage of assumable loans. Many of our clients, both local and those relocating to Dallas, find themselves in that kind of position. The Dallas real estate market has been robust. We've seen seasonal drops, and then we've seen rebounds, but overall, home values have trended up. And this is ideal for sellers who can leverage their home equity into a sizable down payment for their next purchase. Keep in mind, the equity you've built up in your current home isn't just a number on a paper, right? It is a powerful financial tool that pretty much does you no good whatsoever with interest rates at 7%, but a world of good if you're assuming a 3% mortgage. So let's just say you're intrigued by the idea of assuming a mortgage, but don't have a big down payment ready to go. Well, there are still ways you could possibly make it work, but it's gonna be a lot trickier. One option is to secure a second mortgage to pay the seller his profit. Be warned though that this can be a tricky route, okay? The lender of the second mortgage will probably be different from the first, and you might be hesitant about taking a second position behind the first mortgage. Another possible option is asking the seller to carry a second mortgage. Now, this is where you want to really capitalize on your motivated seller. At this point, they want out, right? For whatever reason. and you're offering to fully release them of all liability, the out that they're looking for, but you're asking them to accept their profit slowly or to defer it for a while. If the seller really balks at that, they're just not open to a long-term arrangement, a short-term one might be more palatable. And to make it more appealing to the seller, you could keep it short-term, right? Offer to pay all the monthly payments up front in an interest-only lump sum at closing. Now, this strategy could be particularly effective if you're buying from a motivated seller and you know that you're starting out with some equity, right? And what you could do is, like, after the deal closes, you can take out a home equity line of credit to pay off the seller's second mortgage. The seller has his profit and everybody's happy. Now, another option is an unsecured loan. All right, though this is generally going to come with a higher interest rate compared to a secured loan. Unless the seller is close to being upside down, assuming a mortgage typically requires a substantial amount of cash up front. I mean, there are some creative ways to work around that, but it really is best for those who can cash in on the equity from selling their current home. And now, suppose you're saying right now, this is too much trouble. All right, can I just get a reduced fixed rate mortgage on new construction? Well, absolutely. All right, many lenders have been offering as low as 5%. And we've had many of our buyers go that route. But consider this, assumable mortgages can offer you an interest rate as low as 3%. Just to put it in perspective, a $300,000 mortgage at 3% would cost you $1,265 a month, while the same mortgage at 5% would be $1,610. That's an extra $345 each month. But you know what? The appeal of a brand new home is strong. I get that. And there's a lot of new construction on the market right now. But if you decide to go down that route, okay, there are many factors to consider, especially price. If you're interested in learning more about what's involved in buying a new construction home, you can watch this video here where I talk about it in detail. In the meantime, Wendy out.